Steve, it's good to have you back on the program. The one thing that has been flying under the radar are the smaller cap stocks. The Russell had a huge day yesterday. Do you like small caps? Do you think we're finally seeing this rotation back into the, quote, value names again?
Yeah, I do, but I wouldn't call it a rotation. I'd call it a broadening. I don't think growth is about to roll over and die. I mean, I don't think there's anything wrong with the fundamentals there. But I do think that we've exited recession. We're now in recovery. And as the economic recovery kind of broadens, so will the market strength associated with that. And I think small caps really have three ways of winning in that environment. One, they're very cyclical. So as the economy improves, they should benefit. Two, 50% of their debt is floating rate bank debt. So with rates low and likely to stay low for the foreseeable future, that's a tailwind. And three, they generally tend to outperform large caps by 25% in the first year following a recession bottom. And it seems as though they're starting to do that.
Do you think they'll continue? Because I don't care, Steve, what they've done. I care what they're going to do.
No, but Brian, they haven't. That's the point. They've only outperformed by a couple of percent off of the March 23rd bottom. And so we think that that's the beginning of what's going to be a much broader move. The story is this. We're going to post most likely the best quarter-over-quarter GDP growth in history in the third quarter. And small caps are going to benefit from that. They need that in a way that some of their larger cap brothers don't. And so we think that that is going to be a big theme, along with value catching up and international as well. But we really think small caps are going to be at the center of this going forward.
Well, I mean that was, by the way, Steve, March was like 6 months ago. I know it feels like 16 years ago or 7 generations ago, but it was actually in March. Are there any of the big cap names that you still love out there? I mean, everyone's, they're overvalued and 26 times earnings, whatever it might be. Do you worry about that?
So look, I think when you put in that PE, you got to put it in perspective. Yes, we're more expensive than long-term averages, but remember, we were paying single digits for stocks between 1970 and 1990 because you could go out and get a treasury bond and it would yield 10%. That universe doesn't exist right now. So given how low bond yields are, yeah, stocks aren't cheap, but they're not as expensive as they look. I think some of the tech names are extended, but when you start to look at some of the value sectors, industrials, you look at energy being as beat up as it is, financials, they're certainly not expensive. And if you do get a broadening out of this economic recovery, we think those names can start to participate. It's not an easy trade to buy into, given how long and how much they've underperformed, but we think that that's the pain trade. Now, you think that's where you got to put your incremental dollars.